In this and next lecture, we are going to explore the lean manufacturing principles and practices. The numerous changes in structural and procedural activities that we have described so far, a lean firm also changes traditional cost management practices. In fact, the traditional costing and operational control approaches may actually work against lean manufacturing. Standard costing variances and departmental budgetary variances will likely encourage overproduction and work against the demand pool system needed in lean manufacturing. For example, emphasis on labor efficiency by comparing actual hours used with hours allowed for production fosters production to keep labor occupied and productive. Similarly, the emphasis on departmental efficiency, machine utilization rates, will cause non-bottleneck departments to overproduce and build work-in-process inventory. From activity-based costing, we know that in a multiple product plant, the use of a plant-wide overhead rate can produce distorted product costs relative to focused manufacturing assignments or activity-based assignments. Distorted product costs can signal failure for lean manufacturing even when significant improvements may be occurring. To avoid obstacles and false signals, changes in both product costing and operational control approaches are needed when moving to a value stream-based lean manufacturing system. Focused value streams and traceability of overhead costs. Costing systems use three methods to assign costs to individual products: direct tracing, driver tracing, and allocation. Of the three methods, the most accurate is direct tracing. Thus, it is preferred over the other two. Assume initially that a value stream is created for each product within a plant. In a lean environment, many overhead costs assigned to products using either driver tracing or allocation are now directly traceable to products. Equipment formerly located in other departments, for example, is now reassigned to value streams, and under the single product value stream structure is dedicated to the production of a single product. In this case, depreciation is now a directly traceable product cost. Multi-skilled workers and decentralized services add to the effect. Workers are assigned to the value stream and are trained to set up the equipment in the cells within the stream, maintain them, and operate them. These support functions were previously handled by a different set of laborers for all product lines. Additionally, people with specialized skills, engineers and schedulers, are assigned directly to value streams. The labor cost of these employees is now directly assigned to each value stream. Typically, implementing the value stream structure does not require an increase in the number of people needed. Lean manufacturing eliminates wasteful activities, reducing the demand for people. For example, when production planning is reduced significantly because of an efficiently functioning demand pool system, some of those working in production planning can be cross-trained to perform value-added activities within the value stream, such as purchasing and quality control. This figure is a visual summary of value stream cost assignment. Most costs are assigned directly to the value streams. However, some costs, such as facility costs, are assigned to each value stream using cost drivers. Facility costs are assigned using a cost per square foot, total cost divided by total square feet. If a value stream uses less square feet, it receives less cost. Thus, the purpose of this assignment is to motivate value stream managers to find ways to occupy less space. As space is made available, it can be used for new product lines or to accommodate increased sales. For example, suppose that the facility costs are $200,000 per year for a plant occupying 20,000 square feet. The cost per square foot is $10. If a value stream occupies 5,000 square feet, it is assigned a cost of $50,000. Should the value stream figure out how to do the same tasks with 4,000 square feet, the cost would be reduced to $40,000. Any unabsorbed facility cost would be deducted from revenue as a separate item. There are some limitations and problems. Initially, it may not be possible to assign all the people needed exclusively to a value stream. There may be some individuals working in more than one value stream. The cost of these shared workers can be assigned to individual value streams in proportion to the time spent in each stream. It is also true that even in the most ideal of circumstances, there will be some individuals who will remain outside any particular value stream. With multiple value streams, however, the unassigned costs are likely to be a very small percentage of the total costs. Finally, in reality, having a value stream for every product is not practical. The usual practice is to organize value streams around a family of products. Value stream costing. Product costing, single product focused value stream. Because of multitask assignment, cross-training and redeployment of other support personnel, most support costs are exclusive to a focused value stream and are thus assigned to a product using direct tracing. One consequence of increasing directly traceable costs is to increase the accuracy of product costing. Directly traceable costs are exclusively associated with the product and can safely be said to belong to it. Product cost is calculated by taking the cost of the period and dividing by the output. Focused value streams provide simple and accurate product costing. Product costing, multiple product value stream. Value streams are formed around products with common processes. Manufacturing cells within a value stream are thus structured to make a family of products or parts that require the same manufacturing sequence. The costs are assigned in the same way as for focused value streams. With multiple products, however, product costs for value streams are calculated using an actual average cost. Using units shipped in the unit cost calculation instead of units produced motivates manager to reduce inventories. If more units are shipped than produced, then the weekly average unit cost will decrease and inventory will reduce. If more is produced than shipped, then the unit cost will increase because the production costs of the units produced and not shipped are added to the numerator, creating a disincentive to produce for inventory. Typically, average weekly costs are calculated weekly and are based on actual costs. Now let's see an example. The actual costs for the auto parts company's value stream for steel wheels are shown in this figure for the week beginning April 6. Assume that during the week of April 6, the company produced and shipped 1,000 units of Model C and 4,000 units of Model D for a total of 5,000 units. Let's illustrate the product costing for single product and multiple product value streams. Assuming that the value stream costs and total units shipped apply only to one model, a single product value stream, the unit cost is $120 per unit. In a multiple product value stream, each of models C and D receives the same cost of $120 per unit. The accuracy here depends on the homogeneity of the products within the value stream. If, for example, Model C is responsible for 50% of the material cost, then the unit cost would be adjusted as follows. First, the unit materials cost is calculated separately for Model C and for Model D, respectively $200 and $50. Next, the average unit conversion cost is calculated, in this case $40. And finally, the unit cost is computed, sum of materials and average conversion cost, for Model C $240 and for Model D $90. From this example, we see that all products in the value stream receive the same unit cost. However, if materials costs are quite different between products, then the average unit cost calculation can exclude materials. In this case, the average unit conversion cost is calculated and then added to the unit materials cost, producing different total units costs. The average product cost is useful provided the products are similar and consume resources in approximately the same proportions, or if the product mix is relatively stable. If products are quite similar, the average product cost will approximate the individual product costs. If the mix is stable, then the trend in the average product cost over time is a reasonable measure of changes in economic efficiency. If, however, the products are heterogeneous or reflect a great deal of variety through custom designing, then the average product cost is not a good measure for tracking changes in value stream efficiency, nor is there much indication of what the cost of individual product is. In this case, other product cost calculation approaches are needed, approaches that provide a much better level of accuracy. We will examine them in the next lecture.